Thank you, Bill. Good to have you back again.
Thank you very much, Steve.
Can you describe briefly what you might call the 9% solution?
Sure. The 9% solution came out of a paper we did recently on a particular strategy that involved dividends. The belief that we had was the best you could look for in the stock market was a return of 6 to 8%. It really comes from a belief that dividends currently yield about 2. Earnings in the long run follow nominal GDP, and if you think global nominal GDP could be 4 to 6, you add the 2, that's 8. We're agnostics on PEs, which we can get into. So at best, we think the equity market offers you 6 to 8. But if you could build a portfolio where half of the expected return is cash dividends, to which you could depend on buybacks and debt paydowns of another 150 basis points, we now have a 6% yield. And if it can grow at 3%, we now have a 9% solution. So if you are in a world of 6 to 8, and you actually have a strategy that can generate 9, half in cash, and it has a very low vol, in this case 0.75 relative to the market, that was going to be a very winning strategy, and it's proved to be so over the past few years.
Is this something for all seasons, or is this something you're going to have to change?
I believe it's something for all seasons, but at times it should be married with what we would call a more growth product. Essentially, the universe of securities that we draw from, and we start with 14,000 and run them through quite a large number of screens. But at the end of the day, you come out with a portfolio of something in excess of 100 securities, the whole point of which is to make sure we collect a 4.5% cash dividend, 150 basis points from share buybacks and or debt paydowns, and a growth rate of 3. What that leads you to is a portfolio that is as diversified as it could possibly be and get 9, but it's not as well diversified as the owner might like in the very long run. So a good match or partner for what we do would be a true growth company or a true growth strategy. So many of our clients, and 5 years ago we had $0 in this, and now with that strategy is $10 billion, and it's in every continent in the United States, or every continent in the world. And it's still going to continue to grow, but it needs to be married with a growth strategy at some point.
Meaning?
Well, there are companies, when you look at a dollar, when a company's generate $1 of free cash, there's only 5 things they can do with it. They can pay a cash dividend, buy back stock, pay down debt, make an acquisition, or reinvest in the company. Now, this dividend strategy that we have focuses on those companies that for one reason or another will give you back most of your free cash flow. They simply don't have the opportunity to reinvest, or acquisitions don't make sense. So it becomes more of a return of capital strategy. But there are many companies out there that if they can earn their cost of capital or higher, they should reinvest in their business or make acquisitions. That's a true growth company. We will have fewer of those in our dividend strategy, but that to me is a true definition of a growth strategy.
So in terms of those, what you might call building blocks to get to your 9%, what you might call the weightings within that 9 can fluctuate all over the place.
Right. You want to own as many names as possible, and let me elaborate on that point.
Because you make the point that a lot of industries are going to be underweighted, and
yes,
others are going to be overweighted, but that's just a byproduct.
It's absolutely true. It's just a byproduct. Now, all money managers are charged with doing one or two things: maximizing return per unit of risk, or minimizing risk per unit of return sought. Now, the former is what most mutual funds and most investors are doing. Somebody gives you an index as a benchmark. You untie yourself, and you hope to add some value to the index because that's required for the lack of diversification you've built into your portfolio. Our dividend strategy is different. We're really minimizing risk per unit of return sought. All we want to do is get the 9%. We will buy any company anywhere in the world that does that. The more names, the better, because the more names in the portfolio, the higher the likelihood you're actually going to get the 9%. You want to shrink dispersion around that 9% expected return.
So like a Buffett, the more the merrier.
The more the merrier, yes.
Let's first, before discussing PEs, Apple. Where does Apple fit in this?
We have owned Apple for almost 10 years. We have gradually sold Apple as it's gone to roughly, at one point I think it peaked out at 5% of the S&P 500. and our weighting today is about half of that. Apple is clearly facing more competition. It's facing more competition in the smartphone world and the iPad world, but it's still an amazing entity. We actually think the fourth quarter is going to be quite good. You're going to see a lot of new iPhones sold, and the mini iPad will sell pretty well too. But in many respects, you've probably passed the inflection point on any curve of value in Apple.
But it still meets your criteria?
It would today. We do not own it in a dividend strategy because, as you know, Apple has a huge cash hoard, something like $160 billion. They would not meet our test as the best capital allocator. On the other hand, with Steve Jobs as the visionary leader, he built an amazing company, and it's an amazing ethos that remains.
In your world, PEs don't really matter. It's a matter of cash in hand.
And yes, and it's a little of both. PEs do matter in the sense that you want to basically buy a company at the right price. But it's true in the dividend strategy, the price is secondary. It's all about finding a company that'll meet those criteria and then doing enough homework and enough work supporting the data that they will continue to do the capital allocation they've done in the past. And if you can buy it so it meets the 9% yield, we're happy with that. Many of our other strategies, though, price really does matter. And it matters because that's the cost. So often people will say, it isn't the price at which you sell your product, it's the price at what you bought the product to sell. So the price that is going in, it does matter. PEs are really driven by three variables, and I think people today overlook a couple of these. Price-earnings ratios are inversely correlated to interest rates. Most people know that. We have incredibly low rates, artificially contrived, in my view, to some extent today.
Not to some extent.
But they're artificially contrived, and so they have set up a situation where there's only one way for rates to go up. They're likely, sooner or later, they're going to go up, and that will be a headwind to price-earnings ratios. But there are two other factors. First of all is sheer volatility. If you think the market going forward, the stock market, will be more volatile than we've had in the past, that's a headwind too. In other words, if you have two investments and with the same expected return, but one has twice the volatility, you'll pay less for the one with all the volatility. So I don't know what the future holds, but I would argue the volatility has increased over the past few years. That also provides a headwind to equities. Thirdly, and this goes back to future growth rates, the stock market is essentially a present value machine. So if you think earnings are going to grow at 5 or 6%, that will have one PE. If you think it's going to grow at 2 or 3%, that's another PE, and it's a lower PE. Now, one of the things we've learned from this global financial crisis, thanks to really the quality of work done by Ken Rogoff and Carmen Reinhardt and their fabulous book, This Time It's Different. Right. One of the takeaways is when you get that to GDP as high as we've got, future growth rates are less. If future growth rates of nominal GDP turn all into future growth rates that are less than the past for earnings, that's also a headwind. So the outlook for PEs in our view is it's okay, we're agnostic, but boy, you can see some headwinds coming down. And basically our view is we're agnostic, probably won't go up a lot, probably won't go down very much.
So it again gets to, you want that return.
You want the return. It gets back to dividends and earnings are basically the sole sources of return. Now, all of that said, one of the studies that we've done, and it's been very evident this year, is that when you look at the key drivers of the stock market, it's been PEs. You've had a PE rally this year of roughly 20%. It's all been driven by quantitative easing in our view. There's been very little differentiation among the names in the stock market. It's been risk on, risk off. First quarter was risk on, second quarter risk off, third quarter risk on, and so far this quarter's pretty much been risk off, and we're back to pretty much a single-digit return.
Now the problem with PEs is it depends on accounting.
Definitely depends on accounting, and many, many years ago when Lou Rukeyser was alive, he asked me a question. And he said, Bill, you're a CPA, you're an accountant, is that helpful? And I gave him a line that my wife still regrets I delivered, but I'm going to tell you the same line. and that is accounting is like a bathing suit. What it reveals is interesting, but what it conceals is vital.
And make the point about assumptions and everything else that goes
The more
into it.
accruals you see in accounting, the less truth you're getting. You need to strip away the accruals to understand how any business works. The minute you can't walk a dollar through the revenue line down through all the costs and see what comes out at the bottom, that's a problem. And as a firm, we stay away from those companies that have lots and lots of accruals. It's very difficult to understand how they make their money.
So free cash flow is as cold and good a determinant of
Free
what's
cash
really happening.
We once won a business from a hospital actually in Detroit, and the retirement committee was run by two ex-heads of accounting firms, and my colleague and I, 5 minutes into our presentation, said, listen, the only thing we accountants cannot hide is cash. We won the business.
That's great. Relate the story about the investor who said, why should I be in equities for 12 months?
One of the problems when you own anything, there are really two variables you want to know. What's the expected return I get from buying this asset, and what's the level of certainty that I can have in getting it? So periodically, we're always asked, so what do you think the market's going to do over the next 12 months? And you will give a number. We usually give a number of 6 to 8%, historical averages. But there really is a better question. What is the degree of confidence you can have in getting the 6 to 8%? Well, in statistical terms, one standard deviation, which kind of captures 2/3 of the possibilities, is generally around 17 to 18%. So if someone said, I want a 95% confidence interval around the number you're going to give me, I would say 6 to 8% plus or minus 35%. That volatility is so large that over 1 year, there's almost no reason for you to own equities. Your holding period has to be longer. It has to be 3 years or 5 years or 7 years. That didn't matter in the 80s and 90s because the stock market compounded at 17.5% for 20 years. People got used to this is the greatest thing since sliced bread. That ended in 2001 and 2. So our view today is we still think stocks are going to trump bonds. Free cash flow yields are more than bond yields, and bond yields today are actually less than various inflation measures. The outlook for bonds to me is terrible. But equity should beat them, but your holding period is going to have to be longer because the annual expectation of equities isn't sufficient to offset the annual volatility of equities right now.
So do you think people are maybe making a mistake in buying dividend stocks because I can't put it in a savings account, can't buy a treasury bill, can't buy a bond, I don't get anything for it, so they're treating equities as bond substitutes, but they're not?
Well, I think you have to be careful between what we call dividend payers and dividend growers. Dividend payers are high-yielding stocks, but very often they're not supported by growing cash flows underneath the dividend. They have reached pretty high valuations today. And
what areas would they include?
Well,
Utilities?
it would include some utilities, some telecom, and believe it or not, some consumer non-discretionary ones. But what you really want to do is find a company whose basic business has a growth rate, that there's an underlying growth rate to the free cash flow. And for us, it needs to be at least 3%. But there are a lot of these businesses out there. You can look at something like an Anheuser-Busch. You can even look at Microsoft. You can look at Nestle. These people grow their free cash flow in very high single digits. And if you have dividends, when we define dividends as the sum of the cash, share buybacks, and debt paydowns.
Coca-Cola would be one.
Coca-Cola would be one. Nestle is one. These don't, the cash yield might appear to be little, but when you add back the share buybacks and debt paydowns, it's quite high. And those are, we call them global champions as well. They're great companies to own. They're going to work in the future.
Do we have a bond bubble?
I think we do have.
Manufactured by the central banks?
We definitely have a bond bubble. The biggest danger to my statement is we have insufficient aggregate demand around the world to absorb the resources that are available for production. So think of Economics 101 when people say that economics is a study of the allocation of scarce resources, land, labor, and capital. Well, the reality today is we got a lot of labor in the world that's unemployed. We have lots of idle plant in the world. We're short demand for the utilization of those resources. So the biggest danger in the world is that we don't get growth fast enough to absorb this. Now, the central bank, Bernanke, I think, said this publicly, we're kind of learning by doing, a little scary statement.
Yes.
But he basically indicated that if we can get asset prices up, we will essentially have a trickle down. There'll be people who benefit from higher asset prices. Those individuals will spend some of their money, and it will trickle into the real economy. We've seen very little of that. The money has been created, but it's trapped in the banks. It hasn't gotten out into the real world through loans. A little bit of a pickup, but not sufficient.
You make a distinction, an interesting one, before we get to stocks, pension funds, between private pension funds and state pension funds.
Well, I think in the public pension funds, and I used to serve on the board of the state of New Jersey's pension funds, and there was one leader there who did a fantastic job. He made one decision back in the early 80s. He put 70% of the fund into equities, and 20 years later, it was an amazing result. The problem that politicians have done is they've kind of used this as a piggy bank. They've kept raising the assumptions of returns, and they've created a nightmare for the citizens of those respective states, and that includes New Jersey. These assumed rates of return are almost impossible to deliver. One of the things I would argue that's going on is the states have moved to higher risk assets, but they're not marked to market. So they've moved away from publicly traded assets such as stocks and even bonds, and they've gone into hedge funds and they've gone into private equity. Not sufficiently knowledgeable about hedge funds, but I do know a lot of private equity is not marked to market. That's a wonderful asset, that's a wonderful business to be in if you don't have to mark your assets to market. And I think there's a day of reckoning coming, certainly for California, even more so for Illinois, where they're essentially broke with regard to their pension funds.
So a lot of the valuations, like houses, were make-believe.
I think a lot of the valuations are make-believe, and I have to be careful with this. We have a number of states as clients, but I think the best disinfectant is sunlight, and I think it was Oliver Wendell Holmes that said that. And to me, the truth shall set you free, and you never, ever want to get astray from the truth. And I think transparency of valuation is critical to solving many of our nation's problems.
You made the point, and then we'll get to the stocks, about GDP, debt to GDP ratios. When you get to 90, you've got a problem. After World War II, this country's GDP to debt to GDP ratio is about 100, 125.
Correct.
We did good things. The debt didn't go down, but the GDP went up. So by the late 60s, it was about 35 or 40.
Correct.
It was done in a very non-painful way.
Right.
Can we do that again?
No. And I say that emphatically because when we came out of World War II, Japan was devastated. Europe was devastated. The only growth engine in the world was the United States of America. The amount of pent-up demand in the United States by itself was enormous. There was huge pent-up demand for consumer durables, washing machines, autos, and so on. So, and there was no capacity. And then when you added in the devastation that existed in Japan and in Germany, by the time you've got around to supporting those goals, the Marshall Plan, the rebuilding of Japan, it was a fantastic period for growth, and we were able to grow our way out of that problem. We also had a policy of going back to something called the 1946 Full Employment Act. And that act was passed in 46, mainly by politicians who were looking back after World War I, where we had the experience of the 20s and then the Depression, and they charged the Fed with doing three things: no inflation, full employment, and growth consistent with full employment. And to this day, that's still the charge of the Fed. But serving three masters is very hard to do. And when you look back on that time period, we basically did have full employment. We basically did have rapid growth, but we didn't contain inflation. And eventually, we kept bond rates down through the 50s and into the 60s, but it was a terrible cost to the bondholder. They lost purchasing power. Loss was enormous. Then basically we entered the 70s, and of course we know what happened then. It was stagflation and a serious problem. Today, it's going to be incredibly difficult to grow our way out. Real GDP is dependent on two variables: growth in the workforce and productivity. So whatever you think the growth in the workforce is going to be, and in our case, we need to grow 100,000 people a month in the employment world just to keep the unemployment rate the same. We have about 130 million people employed in the U.S. Demography adds about 1.3 million a year. We got to add about 100,000 to the workforce every month to keep the unemployment rate where it is. Getting 200,000 people to work in America right now is tough. Manufacturing's not going to do it. So it's the service economy, and the service economy has lower wages. So when you look at real disposable income per capita, boy, the growth rate outlook there is very, very modest at best.
Question related to that, Obamacare, Affordable Care Act, the huge cost coming on that. Are we going to see more and more what we saw this year, where job growth comes with part-time? People don't want full-time employees in those liabilities, and they'll do anything to get around that?
In some industries, I think you probably will see that. I think President Obama meant well in the sense of spending his first year on health care, and I think there is an issue with many, many Americans being uncovered. I think the means that was addressed to handle that problem was excessive, and with hindsight, I would have suggested that he spent that first year on the wrong agenda.
Right.